Hello everyone and welcome back to another financially fluent video. Today's video is inspired by one of you. Someone wanted to know, is it wise to borrow a Sacco loan and then invest it in stocks? And so this is my response to you. I'll start by letting you know this. Only borrow from a Sacco to invest in stocks if number one, you have stable income. That means you are able to pay off the Sacco loan without any hassle. And then number two is if the loan interest from the Sacco is small, that is roughly 8 to 12% in an year. And then number three is if you have a clear stock investment strategy. You cannot start investing, you cannot put a loan to invest in stocks if you do not understand what it is you are investing in. So if you have a clear strategy of the stocks that you want to start investing in, then you might take a loan and invest in them. And number four, you are investing for the long term. So remember that stocks are high risk, high return investments. So for you to be able to properly reap from stocks, because stocks usually fluctuate, they are very volatile. So for you to have that shield from the volatility of stocks is that you need to invest for the long term, and that is 5+ years. That is the only way you'll be able to shield yourself from the fluctuations or the volatility that stocks usually have. It is not a wise idea to invest in stocks if, number one, you do not have an emergency fund. And why is that? Because in case of an emergency, you will not only struggle in taking care of the emergency, but also in repayment of your loan. Because remember, when you borrow from a Sacco, you are paying back that loan on a monthly basis. So if an emergency pops up and you do not have an emergency fund, then how will you be able to pay off that Sacco loan? Number two, do not invest using a loan if you need short-term profits, because remember, how do stocks work? Stocks give you a good return in the long term. So if you are borrowing from a Sacco thinking that the dividends or the capital gain is what you'll use to pay off the Sacco loan, you are very mistaken, because stocks need they need a long time. They need a good time for you to be able to reap properly from them. And then number three, do not invest if you do not fully understand the stock market. If you are gambling, if you are gambling with the money that you have borrowed, and it's not even your savings, it's not your own investments, it's borrowed money. You cannot risk. There is no way you'll risk putting borrowed money into something that you do not fully understand. So if you do not know what you are getting into, I'd advise for you to first learn about stocks investment, and then from there, if you feel you've fully learned and you're good to go, then you can proceed to borrowing from a Sacco and investing in stocks. And then number four, do not invest if the loan repayment of the Sacco is aggressive. That means if the loan repayment has a short-term payback period. If you're required to pay that loan in an year or less than an year, then that payback period is very short. That repayment will strain your monthly cash flow. All right? My general advice is, number one, it is better to invest in stocks using your own savings and not borrowed money. And then the second thing, if you must borrow, then borrow a small manageable amount of money that you'll be able to repay back without straining. And then do not put all the money in the investment of stocks. Maybe you can try with 20 or 30% of the borrowed money. See how the stocks are taking you. If you see that it has a good payback, it has a good profit, if you see that the stocks is something that is working for you, then you can now go ahead and put in the 100%. But of the amount of money that you want to borrow and invest in stocks, do not put all of it in stocks. Start with 20 or 30% first. And then apart from stocks, when you are borrowing from a Sacco, try venturing into other less risky investments that will give, even if the yield is small. But first, test the market before you can move into giant investments like stocks, because remember, stocks are high risk, high returns investments, but that is if you truly understand them, because they do fluctuate. You might buy a stock at 50 shillings and then you wake up tomorrow, it has gone down to 20 shillings per share. And stocks are really good for long term. For you to be able to get that capital gain, stocks are really good for the long term, not short term. All right. So, in short, it's not necessarily wrong, but it is risky unless you have a financial cushion, that is an emergency fund, you have a deep stock market understanding, and number 3, you have a long-term mindset. Do not be there just for the short term. But if you decide to go ahead and borrow from a Sacco to invest in stocks, first of all, answer these questions that I'm going to lay down for you. If your answer is yes in all of them, then you can give it a try. But if you have no on most of the questions, first wait and study the market. The first question is, do you fully understand how the stock market works? That is the risks, the timing, and the types of stocks. If it is a yes, proceed. If it is a more, study more first. Number 2, is the Sacco loan interest lower than the average stock return? That is basically less than 10%. If it is yes, then you can proceed. But if it is no, then you need to reconsider. Number 3, do you have an emergency fund that is at least 3 to 6 months of your living expenses saved? If it is a yes, proceed. If it is a no, build your emergency fund first. Number 4, can you comfortably repay the loan without relying on stock profits? If it is a yes, proceed. If it is a no, it is too risky for now. Number 5, are you investing in safe, proven stocks? If it is a yes, go ahead. If it is a no, then research on better options first. And number 6, are you willing to stay invested for at least 5 years without needing that money urgently? If it is a yes, then proceed. If it is a no, then it is not ideal to borrow at this particular time. Even if you meet all of the conditions, only borrow a small percentage at first. That is about 20 to 30%, so that you can be able to test your strategy and see if it truly works. If you decide to go ahead and invest in stocks, number 1, invest in dividend stocks. So these are companies that usually pay dividends after each and every year. They might pay twice in an year, maybe after 6 months, and then at the end of the year. But why do you need to invest in dividend stocks? So that you can have a stable income and stability, okay? Number 2, invest in blue chip stocks. And blue chip stocks, these are large, well-established and financially sound companies. And why do you need to invest in blue chip stocks? This is for safety and long-term growth. Blue chip stocks have a lower risk compared to small companies, and they usually survive economic ups and downs. Number 3, you need to invest in growth stocks. So growth stocks, these are companies that reinvest profits so that they may be able to grow faster. And they do that so that you as an individual can have higher long-term returns. So growth stocks usually have their high risk, but they also have high reward. That is given a time frame of, let's say, 5 to 10 years. If the companies grow big, they have a very huge high return. What you need to have in mind is that if you are investing borrowed money, first work on defense. Work on defense first, and then growth will come later. So by saying work on defense first, this is what I mean. Let's say, for example, you have borrowed 50,000 Kenyan shillings. So how will you divide that 50,000 into your stocks, in your stocks portfolio? This is a case example of how you will divide it. So number one, you need to invest 30% in a dividend stock. 30% of 50,000 is 15,000. And why are you investing in a dividend stock? That is so that you can be able to build strong dividends and also have a growth potential. After you have invested 30% into a dividend plus growth company, invest 25%, that is 12,500, into a blue chip plus dividend company. And that is blue chip companies, remember I said these are large companies which are financially sound, and an example of a blue chip company are banks. So why are we saying that you invest in a blue chip company? That is because you'll have steady performance, because as I have said, most of the blue chip companies are usually these large banks that are in the NSE. Number three, the 20%, that is 10,000, invest also in a blue chip and dividend company as well, another type of blue chip dividend company. That is so that you can be able to have good dividend payouts. And then number four, also invest in a different blue chip company. A blue chip company, these are just large companies like some of the banks that we have in the NSE. You need to go and research them. I don't want to start mentioning names. For number four, also invest in a different blue chip company, and that you'll invest 15%, that is 7,500. And for this time round, find a company that has a strong brand. And for number five, invest in a growth company, that is the remaining 10%, which is 5,000. They have a higher risk but possible future return. Okay. Why would I recommend such a mix? This is because number one, you have stability and regular dividend income. Number two is that you're investing in different large companies that offer dividend and are also stable and reliable and secure. For number three, remember that you've also invested in a growth company. Growth companies have higher risk but higher returns. So if things go well, then you are guaranteed of a higher return. So it's like adding a little bit of spice to your portfolio. What are you likely to expect from this portfolio mixture? Number one is dividend payout annually. Number two is stock price growth. That means in a period of 3 to 5 years, if the companies perform well, then your capital will also appreciate. You'll have a capital gain. Number three, you have low stress because you have invested in strong and proven companies. There are two bonus tips I'd like to share with you. And number one is reinvest your dividend. Reinvesting your dividends enables you to compound your returns. That means you're building on your portfolio. And then number two is do not just invest the 50,000 and let it stay at that. On a monthly basis, try to top up even if it's 1,000 or 2,000 bob. That makes sure that by the time you're finishing with the repayment of your Sacco loan, you have also built an investment portfolio, and you don't have to borrow again to fund or to continue building that investment portfolio. Three things that you need to put in mind if you decide to go through with this. Number one, make sure that you set your loan repayment plan. Know how much you're repaying every month and make sure that you never miss a repayment. At all costs, protect your credit score and your relationship with the Sacco. And then number two, reinvest your dividends. For this first year or 2 years that you are repaying your Sacco loan, make sure that you reinvest your dividends. Okay, do not be quick in using your dividends. Reinvest it first so that you can be able to grow a strong portfolio. And then number three, set a mini reinvestment plan. That is on a monthly basis. Even if it is 500 or 1,000, make sure that you are topping up that investment, that the stocks that you bought. Make sure that you are buying, even if it's 500 or 1000 worth of shares each and every month. So, how is all this working together? Number one is you make sure that every month you are repaying your Sacco loan. And then number two, for the dividend payouts, make sure that you reinvest 100% of your dividend payouts. Buy more shares using those dividends. Number three, make sure that on a monthly basis you are topping up, even if it's just 500, 1000, how much, whatever amount you're able to top up. Make sure that on a monthly basis you are topping up something to that stock investment plan. You will realize after 12 months or 24 months, depending on the period that you are repaying your loan, you will have already repaid your loan and you will have a larger stock portfolio that is earning you dividends. By the end of year one or year two, you will realize that you will have already repaid off your loan. Number two, your investment portfolio will have grown naturally. And then number three, you will have developed discipline and wealth building habits. That is because remember, you have been adding up like 500 to 1000 worth of shares each and every month. You have repaid your loan. So you have developed debt repayment strategies, you have increased your portfolio, you have developed discipline as an individual and wealth building habits. And number four, you are in a position to reinvest bigger amounts without using debt. So this marks the end of this video. To the person who wanted to know if you can take up a loan and invest in stocks, by following what I have just taught you right now, you'll be able to gauge yourself and see if taking up that loan to invest in stocks is a good idea, or you should hold and study the stock market first, get to understand it, and then be in a position to invest in stocks. So with that, I'd like to stop there for today. I will see you in my next video. Bye.